Hello, guys. Can you guys hear me? I can see the camera working. Hello. Can you hear me?
Hey, yeah, we can hear you.
Okay, perfect. How's it going there for you guys? Did you guys have a lot of damage?
No, none at all. It was sunny.
It was sunny. No, I know, but
No,
from
no.
Friday.
It never even rained. I mean, we had a little wind and all that. The wind, the lights went out every now and then, but it didn't even rain here.
No, it didn't rain. Well, that's good to hear.
All
right, is Mike joining us today or just you two today?
I think he's in a meeting today.
I'm sorry, I didn't hear you.
I think Mike might be in a meeting right now.
Okay. All right, cool. So we will go ahead and get started with risk management for trading, for successful trading of stocks. And this is pretty much number one that you want to concentrate on with trading, because if you go in with the mindset, hey, I just want to make money, many times you're going to get in a little early. You might not wait for the proper indications to fully get into a trade, and it can result in losses. Hey, Mike.
Hey, how's it going?
All right, so we have the legal disclaimer every time that it's for educational purposes, and all the ideas are best to be practiced on paper trading first, so you guys get those habits down. There are varying degrees of risk in all trading instruments, and no past performance is indicative of future performance. So we're going to talk about the risk first. And when you are trading and you have your losses, because they will come, that you will see that if you lose 10% of your account, it's going to take you 11% to get back to break even where you started. If you lose 20%, you have to gain back 25%. So if you are not managing your risk right off of the bat, you are going to end up, if you go down to 50%, I was learning, I didn't cut my losses quickly, I didn't step in when the stop told me to get out, then you're going to have to work really hard to get back at your original capital, let alone moving forward with profits. And so that's another reason why it's super important to practice on paper first and find that strategy for you. If you are moving forward and you are just dealing with loss after loss after loss, you're just going to go ahead and eat right through that capital. And it's not going to be the best for your morale, as well as best for the capital that you have and you can put into your account to trade with, right? Okay, so when you're also looking at it and you're aiming for small gains, like 1% of your account a day in gains, great. Over 1 year, you are going to end up with 37.78 times your money, right? If you end up with one loss day by day of 1%, you're going to end up with 3% of your overall capital in a year. So risk management is very, very important, and keeping those losses very small. If you constantly lock gains of 1% or more, your account is going to grow. And many times you'll see a trader's account grows exponentially like this. It's growing up and up and up because you're constantly in that habit of taking profits. You take a profit, you might take a partial profit, whatever it is, you are locking a gain into your account. If you take a partial profit at, say, 25 cents, great. 50% of your position, you took profit, you're moving one step forward. You're not going in that backward motion, because that, as a beginning trader, is what's going to really hinder you from the long end game of surviving in the trading world. I broke it down to for returns for a year, right? So again, if you had that 1% gain every single trading day. Now, it's 365 days. So you're going to be looking at, you have roughly 290 trading days in a year. So it'll be a little bit off, but for 5,000, you're moving forward and you'd end up with roughly 188,000 in a year. 10,000, 378,000, 20,000, you're going to end up with 758,000. 1 year of losses, you have 5,000, you're going to end up with $150 at the end of that. So it's really, really important to stick to that risk management, right? And you are going to be an imperfect trader. On average, it's like a baseball player, right? They have a 30% hit rate or run rate. I don't even know. I don't really track baseball. But there's no perfect baseball player. There's no perfect trader at the same time. So you have to remember that when you are trading, you are likely going to have 7 winners and 3 losers. So that is going to be a fairly good ratio, 70% or greater. When you start going to 50-50, 40-60, meaning you're having 4 wins, 6 losses, now you're eating at that capital again. That's not where you want to be. Stop, take a step back, go to paper trading, figure out what is going on, because it's not going to end up being a winning scenario. You have to constantly work at keeping that risk management, the losers very small, because if you are having 3 losing trades and 7 winning trades, and your losses are double the size of your wins, you're going to progress at a very, very slow pace. You'll still be moving forward, but it's going to be much slower. So I like this. All traders have the idea of getting started with the get rich quick scheme, right? But it's not that. You have to put in the work. 40% of traders will try to trade, no education, they get done. 60% are still in the game, and 80% of those 60% are going to quit within the first 2 years. Likely they've run out of capital, they're frustrated psychologically, and it's really only the last 2% that will make it in 5 years. And it's a lot of it has to do with the psychological aspect of it. It seems really easy. Trading's easy, but it's hard. You have to have that patience and that discipline to be able to get into a trade at the right time and pull the trigger to lock your profits at the right time as well. Taking the profits is very, very important. You want to get in the habit of taking profits and cutting losers, because as you grow that account, little growth, as you saw, 1% every day will give you 37 times your money. So aim for that base hit instead of the home runs, because those base hits are going to be what grows your account day by day. It might seem difficult in the beginning, but as you build those habits, you build those reactions, you will find that you will be able to position larger. You're going to trust yourself. You're going to trust your strategy, and you're going to be more comfortable in the trade. If you are also getting into a trade and maybe you're swing trading, you're trying to avoid a PVT rule, and you're swing trading and you might have bought a penny stock with $5,000, right? And it's $5. So you have 1,000 shares. Well, let's do it here, right? you have the 1,000 shares at $5 to give you $5,000. Not your whole account, right? You don't want to ever risk your whole account on trade. Well, then you happen to see that this drops down to $4.80, right? It opens up at $4.80, or you see that after hours. You guys know that the after hours goes until 8 p.m. 8 p.m. you see it at $4.80. And you think, oh man, I'm already down $200. You know what? And you toss and turn all night long. You're not comfortable with risking but $200. Then you wake up and it's down at $4.50. And you're now down $500, right? Well, maybe that $500 is too much, right? That can really affect your ability to think rationally, and it might make you sick to your stomach. Maybe if you'd simply taken 100 share position. And when you're paper trading, it's important to practice with different position sizes. Practice to see your comfort level for your entries, right? Practice to see if you are comfortable with 1,000 share position. It moves 20 cents, you make $200, great. But what about the flip side? You always have to think of where could it possibly go and how much am I willing to risk? Because yes, it could go up. However, it could also very quickly go down, especially if it's a lower float stock and there's a lot of momentum on it that day. It could very easily flip against you, and you have to have those trigger fingers to pull the trigger and exit that trade. If you'd practice same stock, 100 shares, if it goes down 20 cents, you have a $20 loss. That can seem much more manageable than a $200 loss, because you only potentially thinking of that gain that you could have instead of the loss that you guys could have. Have you guys experienced that at all? Mike, you seem like yes, but you don't want to say anything.
We started a little contest, like a little 10K contest.
Yeah?
We started with that. So I actually went small. I didn't really buy nothing big. So I didn't really lose nothing. I didn't really gain nothing. So.
All right, hey, so I've been with the paper trading for 2 weeks. I started off with 100,000, but now I'm doing it with 50,000, just to try a different amount.
Okay. Best thing. Sorry? Or did it go down to 50,000 and now you're starting out?
No. Actually, I was up about 3,000, but I was like, man, I'm playing with 100,000. Yeah, I just wanted to bring my position size down a little bit to see how I would do with 50,000. That's it.
Okay.
I was actually up.
Okay. It's best to practice with the real capital that you're going to use. So if you are going to use 50,000, great. Practice with 50,000. If you're going to be trading with 25,000, use only 25,000 in your paper trading account. Keep it realistic so that your expectations of results will be more realistic when you are paper trading. You don't want to get in 100,000 and you're going to be trading with a quarter of that, or you might even start off with a smaller account of 5,000 and that's 20%. So then you're in the paper trading account, you're making 5,000 a day, and then you go to making 50 bucks a day. You're like, man, this isn't the same as when I was paper trading. And you might get discouraged because it's not a realistic simulator. You have to do it with a realistic amount because you don't want the results for the simulator to be false and give you that false hope when you switch to real money. You want to try to keep it as real as possible. All right. So trading is a marathon, right? You guys saw it's very few people that will still be in it 5 years later. So it's like the Aesop's fable with the tortoise and the hare. Those small little gains all the time are going to be what will really help you secure your habits, grow your account, instead of trying to go for the home runs, the 300 to 500% winners every single day. They could very easily go to 100% loss for that position. Well, maybe 50% loss or 30% loss. And as I mentioned before, on that risk management, if you have that drawdown, you have to work that much harder to put it back into your account. So when you have the great habits of cutting the losers quickly, we'll talk about the actual entries a little bit more with the trading, but keep it small, consistent, and almost boring. Trading should really be boring and mechanical instead of, oh my goodness, I had this amazing trade. If you're getting emotions tied into it, that can really hurt you and hinder you, because then maybe you end up having a loss and you start revenge trading because you're thinking, I have to conquer this stock. I need to make back my money. And that's when you need to step back and say, you know what? No, I had maybe 3 losses for the day. All right, those are my 3 out of my 3 out of 10 trades. I'm done. I'm walking away. Right? Or if it's one big loss that you let it get too far against you, nope. If you feel emotional about that trade, and this is somewhat easier for women because they can say, you know what, that stung a little too much. And sometimes in general for traders, men want to conquer it. So you have to be aware of it, and you have to be aware of your emotions. Hey, you know what? I'm stepping away from this. I'm stepping away from trading for the day because I am feeling like I need to revenge and beat this market, but that market will always eat you up and swallow you, right? There are huge sharks in the market. They will take all your money. So do not try to beat the market. You can go with the trend, go with the big guys, but don't try to fight them. And there's 10 really important traits of successful traders. You guys are already working on the understanding part, right? We're working on the risk management. Paper trading is going to teach you more discipline, right? And you're also going to be able to maintain your records with paper trading and journaling. You want to really journal your trades as well. We'll talk about that more on Friday. And in doing that, you're going to learn from your mistakes, right? You don't want to ignore when maybe you are trading in the middle of the day and you see, oh my goodness, from 11 to 2:30, I have a 30% win rate. That's mine. From 11 to 2:30, I win 30% of the time. So you know what I do? I shut down my computer, I go to the gym, I do something else, because I've tracked my trading habits to see that I am not good in the market at that time of day. Couple of reasons. In the morning, I'm fresh, right? I'm probably have had proper nutrition. I am clear-minded. I don't have any trades on my mind, and I can look at the stocks and assess them easily. Later in the day, the price action happens. It becomes a little more choppy. It's not a good scenario for me. So you guys have to figure that out for yourself. Everybody is different. For the most part in the market, from 11 to 2:30, the algorithms tend to be in control. So it's not the best time to trade. The beginning, first hour and a half, good, and the last hour, good. Middle of the day, most day traders are not there. And you will see that when we look at the volume on charts. You also want to be curious. Hey, why is this stuff happening, right? And we're going to talk about planning out your trades too. How do you plan out your trades every single day? You really want to have patience for the ideal setups. Not every trading day is going to be stellar. One day you might get a 20% gain. Another day you might get 0.5%. So you want to keep on average that 1% gain every single day on average. But if you're having a day where you have 7 great trades that are long, you might get more than 1%. And then the next day you might have 3 losing trades and you shut up shop and you leave, right? And the interpretation of the market. What is going on with the market? All right, now to the actual orders. When you have, we'll start off with buying first. So when you have the buy limit order, this is the maximum price at which you are willing to pay for the stock. So say we have Apple, it's trading at 125. which it was today, and you say, you know what, that's great, but I want to buy it at 121. So you put in your limit order, and you will buy it only if the price drops down to 121. Got it? Make sense to you guys?
Yep.
Yeah, okay. And then you also have the option, again, of day order, which means that is good until 4 p.m. today. If you do GTC, that is going to be good till canceled, but it will only be active during the market trading hours.
So good forever until you cancel it?
Good till cancel. Usually they'll put it out about 6 months, and if it hasn't executed, then your broker will ask you or give you a notification, hey, this order is about to expire. Would you like to extend that time frame on it? But it's good till canceled. Yeah. So it would be open. Now, if it happens that it's trading 125 today and it only hits your pre-market or post-market activity time, your order is not executed.
During market hours?
Correct. It would only be active during 9:30 till 4 p.m. Now, you can put a day order or an EXT, see if I can write it. So EXT, and that means that your order would be active for the extended trading hours. All right, so that's between 4 p.m. and 4 a.m. That would be open and active. So now sell limit would be just the opposite. Say we have Apple down here, but you want to sell it up at 125, right? The price action has to go up and hit 125, and you have to have 125 usually on the ask side, or excuse me, on the bid side. So that's the most that a buyer is willing to pay to buy your shares. Okay, so it has to rise up to the price. Of course, a market order, if it's trading in between the two, you hit a market order, which is again only good between 9:30 a.m. and 4 p.m. when the market's actively trading. You're willing to take anything that the market gives you. All right? You look like you have a question there.
It just seems like we should just, why would anybody do a market order when you could do a limit order? Like, what's the, why would you do a market order?
I'll show you on the level 2. We'll go to the level 2. But if it's a penny spread on a stock, then you're going to, a market order is not going to make a difference. It's going to get you in right immediately. So if it's trading at 125.00 and 125.01, and you want to get in, okay, it's a penny. But sometimes if you ever watch those really crazy low float stocks that are moving really quickly, it might be trading at 125 and it might be trading at 127.50. I've seen some crazy spreads, right? So it could be, this is the current bid and ask on the level 1 or 2, and it's a $2.50 spread. That case, you would prefer to have a limit order because you don't want to buy it at 127.50, immediately it goes down, and now it's selling at 123, and you want to get out quickly. If you hit a market order, then you know what? You bought it up here at 127.50, you might turn around, sell it 15 seconds later, and you've lost $4.50 a share. So the spread can be a big difference. When you start out trading, it's good to concentrate on stocks that have a penny spread or maybe a nickel spread, not one that has $2.50. Because that one, you're pretty much putting yourself at a disadvantage right off the bat. You're trying to minimize your risk and increase the probability that you will have a winning trade. So when you start off with the easier stocks that have good volume, they move quickly, they're easier to trade, then you have a higher probability of being able to get in, get out, follow the rules, and lock in profits. Good? Yep. Now, we also have buy stop and sell stop. Some people will use these to get in. I do not personally use them to get in. I would use it more as a stop to lock in profits. So if you're in a long position, you would use a sell stop. So for that example, maybe we got in to Apple at, maybe we got in up here at 121, and we have our stop down here at 120. We're willing to take $1 of risk. Apple tends to have a larger range throughout the day, so it's not really a beginner stock, but just for the example, we'll say, you know what, if it comes down to 120, I'm getting out. No questions asked. That's the pull the trigger, sayonara, I'm done with this trade. Non-emotional. This is my point at which my risk is where I'm ready to get out, right? So you put in your sell stop, then only if it comes down to 120 does this become an active order. Otherwise, it just sits there on the market. And when it becomes an active order, it turns into a sell market order. Okay? Vice versa. If you were short a stock and maybe you shorted it at, for the example of using Apple, 124, and your buy stop is 125. Well, if it comes up to 125, I want to get out. I don't want to have a loss more than $1 again. Okay, it comes up, boom, it activates. Now it becomes a buy at market order. So it might quickly jump up to 125.20 and then drop right back down. So it might go like this, jump up, and then right back down. But you had that order to execute. So you still get out, and it might execute up here. It could execute anywhere between here and here because it's a market order. Good? Yeah? Okay. Now, you can also have a sell stop limit order, okay? So meaning, hey, at 120, all right, it came down, but my limit that I'm willing to sell it, the lowest that I want to sell it is 119. So anywhere between 120 and 119, it could execute. If it drops down to 119.75, maybe that'll be where I get executed. Or it could be at 119.50. It could be anywhere in that range that I could be executed.
So if you put it for 119, it could stop at 119.75?
Yeah, it can sell because remember, this is a minimum at which you are willing to sell your stock, right? A limit order is the lowest you are willing to sell it, but they could execute it anywhere between this dollar range. Now they see it at 119, they're going to try to take it down and they'll try to go ahead and execute it as low as possible. So, but at the same time, if you're in, say, that one that we were talking about, it's the high momentum, low float stock. You get in at 120, it quickly goes up to 125 in about 5 seconds, which it happens. And then it comes back down to 120. You've now set a stop in place at 120. And I speak from experience on this because this happened to me when I started out. And you have your stop right here. And then you have your stop limit at 119. And guess what? It goes down to 117. And your order never gets filled. You are stuck in that trade. It does not go to a market order. That stock is continuing down, but your sell price is at 119. Only if it were to come back up to 119 would it execute, unless you change this order to a lower price. Does that make sense to you guys?
Why didn't it execute whenever it crossed
Because sometimes they can trade so quickly. Remember we had a spread before of 125 and 127.50. Well, maybe we have a spread of 120. Here, wait, sorry. Let's do this. We have a trade. We have an order for 117 and 120. Well, there's nobody looking to buy it between 119 and 120. So yes, there's a $3 range right there, but there's nobody. The bid would have to move up to 119. So we would need to see it go 118, 119. Okay, 119, yes, you get out. But if it's a really wide spread and your stop limit is not wider than the spread, there's a chance that you could get stuck in that trade. And then next thing you know, it's down to $80 and it's halted. And now you've lost $40. You lost roughly 50%.
All right, on a halt. Okay,
or 30%.
So if the price halts, is it good to do a stop limit on a halt? Like, okay, so it halted and we don't know if it's about to go, we don't know if it's about to tank or if it's about to shoot up. Can we do a stop limit on a halt? Okay, like let's say the stock's $8. Can we do a stop limit for $7.95 and will it execute after the halt?
You could do a stop limit for $7.95 for sure. So we'll do it like this. So the stock's here at $8, right?
Mm-hmm.
And it's halted. What's on the bid side? What do the buyers want to pay for it right now while it's halted? What's the price that they want to buy it for?
I don't really know.
Maybe we'll say it's $6.50, right? It's going down. The stock's gone up like this, and now it's on its way down. And this is our $8, we'll say. Right? Well, if it's halted on the way down, usually those are not good halts. If you're long, if you're short, you might be doing a happy dance. But if you're long and it's dropping, then it might open up $2 down at $6, or it could open up at $10. Because you don't know who is going to win, whether it's going to be the buyers that take it up after the halt or the sellers that'll take it down.
So if you put a $7.95 stop in right there, it wouldn't execute.
If you put just a sell stop, no limit, it would execute wherever it opens. If it was lower, right? If it opened lower than the $8 and you had $7.95, right? Then it would, and say it opened at $6, then it would execute down here at $6.
That's what happened to me.
If it was simply a sell stop, not a sell stop limit.
Okay, so what if you put a sell stop limit at $7.95?
So if you had a stop, say your stop price is up here at 8 and you have only 5 cents for your limit, it's not going to execute until it comes back up to that $7.95 price.
Oh, I got you.
You get it? Light bulb went on for Mike. Okay.
That caught me off. They had one that halted on me.
Yeah.
And I end up having a stop. I said a stop limit, not with the a stop loss. But it was a straight limit pricing. And so once it opened, it was way below, and probably lost a couple grand just not knowing with the stop limit frame. So it executed way below than what I was planning to walk away from.
Right. You probably just had just a regular stop then.
A regular stop.
Yeah, because once it opened, it turned right to a market order. So it turned into an instantaneous sell. Okay, it's below the $8 or the $7.95 if you're stop.
I said a stop market. That's right.
Yeah.
A stop market order at that price. So once it opened, it was below and it executed.
Exactly. Now you get it. So the same is true to the upside, right? And I've been there too. I mean, I speak from experience. These are all the mistakes that I made in my first 9 months when I was starting out. So I definitely feel your pain. And I did it when I had a 6-month-old baby, and I was like, oh, I'm going to set a stop limit. No problem. Go change a diaper. I come back. I'm down $500. I was like,
Yeah.
what happened? And I learned the hard way. So I'm sorry you learned the hard way too. Oh, I've got alerts going on. So you guys now know the difference between the stop and stop limit. And if you're trading a stop limit, you want to have it be greater than the spread. Okay, you want to give it that space, because if it's trading a wide spread, 25 cents, you want your limit price. So you have your, let's erase everything here. That if you have your sell stop here and your limit is right here, right? For the sake of it, we'll do $8 again. And the spread is 25 cents, right? So maybe it's at $7.75 and $8 means we've already hit the stop, but you want it to be greater than this. So if it's 25 cents, you want to give it 30, 50 cents if you have that limit, if you're using a sell stop limit. Because if you do 15 cents, that's going to, or 20 cents, it'll put you at $7.80. And you need the price to come back up to $7.80 for you to be able to get out.
So put the stop around 770.
Exactly, 770 or 760. You want it to be bigger than that spread. Because if it's not bigger than that spread, you could get stuck in it and it goes down and you're not able to get out, or else you have to do it as a market order. And before you know it, maybe it's down at 675, right? And if you'd simply given an extra 10 cents, you might have gotten out up at 760, right? Sorry, it's hard to draw with these things. So you can see that you would get out, you'd be able to get out. Or for me personally, I only use hard stops when I'm in a profit. Because many times they also sell they sell them to the market because the brokers are interested in making money with order flow. Right? So even if it's a stop order, they still put it out there in the market like it's an order. And if it was at $8 and it's trading up here at $9, well, guess what? Roughly 11 o'clock, when those algorithms are in control and they see all of these orders, these stops lined up, they might take it down, they might take it up, take out the stops up here, and they manipulate the price action in the middle of the day. And so they'll take out stops both sides because they want to fill those orders. All right. So a buy stop would be the same scenario if you are short. And then the buy stop limit, again, would be that price range, the maximum at which you are willing to buy back your shares. Got it? Okay. Then we also have the trailing stops, right? So say we buy Apple down here at 120, and then it goes up and we're at 122.50, right? Well, we want to have $2.50 as our trailing for the example. So that puts us right now back at our entry price of $120, right? You might want to take some off the table up here. You could take off 50% of your position. All right, I locked money, and then I'm going to do a trailing stop on the rest of it. You could walk away from the trade no matter what. You're green on the trade. Well, now we go up here. It's 125, right? Then our stop moves up to 122.50. Well, it's not exact, but. Well, now we come down to 124. The stop never changes, right? Because it didn't advance. Okay, now we move up to 127.50. And now our stop is up at 125, right? So it moves up with the price.
Did you use a percentage or did you use a certain price?
You can do either. So you can do a trailing stop based on a dollar amount, or you could do a trailing stop based on a percentage. I usually like to do a dollar amount, and I will look at the candlesticks. You know, maybe you have a candlestick here, you have a big candlestick here, and then you have a small candlestick. And then I'll take the average of the range. So maybe this one is 75 cents, and we have $1, so we're $1.75, and then 25 cents. So that's $2 for 3 candlesticks, so maybe 65 cents. For that example, I would use as my trailing stop. If I had another big candle like this, I'd get stopped out.
And you would go off of the 5 minute, or the candlesticks you're going off of?
Correct. I would use a 5 minute. If I'm trading a day trade, I would use a 5 minute. If I'm in a swing trade, I would look at daily candles. So it would also depend on the time frame at which you are looking to trade.
Would you say different techniques are better for different time frames? As far as like what are you using? Like what technique are you using on a 5 minute?
5 minute? I'm going to use a 5 minute more for entry, and then also on a swing trade, but it would be at the end of the day. Right?
What indicators?
What indicators am I going to use? I'm going to be using the volume. I'm going to be using price action. I'm also going to be looking at the daily chart. I'm also going to be looking at the moving averages on the 5 minute chart, as well as pivots and camarillas, which I'm going to teach you guys about when we do charting.
All right.
All right. So you guys are going to learn all of it.
All right.
But now you see, we got to add and layer it up so that you understand it slowly but surely. So then it comes back down from 127.50 to 125. Okay. Then the trailing stop, just because it's a stop, it turns into that market order, and it exits your position. You can do a trailing stop limit as well. I just do a trailing stop. If it's come back at that point, I'm ready to get out. I just want to go ahead and lock my profit and be happy with the profit.
You do trailing stop losses on all your trades?
When I am away from my desk, I will always put in a stop, because I never know what's going to happen, right?
All right.
It usually, if it's not going my way, the riskiest time to a trade is going to be when you get into it. If it doesn't go your way right away, get out, right? There's no commission cost. It doesn't cost you anything except for that little bit of a movement.
Right.
Now, if it has a big drop and you don't get out, that's on you, right? Because you didn't pull the trigger to get out. This is non-emotional. This is black and white. Is it going for you or is it going against you?
Right.
Right? Okay, it starts to go for you. Okay, you still watch it. You still monitor it. It starts to go up. It hits your first target. Great. You take some profit. I like to take profit when it hits the first target. Why? It keeps you in the trade psychologically. And then as it pulls back, you don't feel the need to get out 100% because you've already locked some profit. You could let it go back to your entry and you're green on the trade. You already have a profit. It might not be the best profit, but you are still going to be locking profits, and you'll be consistent with locking profits.
Right.
Instead of letting it, one of the biggest things that I did that was detrimental to me in starting out was I would watch it go like this, and then it would go like this, and then it would go like this. And I never took profit. I was like a deer in headlights. I'm like, man, you know what? If I just took some profit up here, then I'd be great, right? And so you have to get used to taking profits and cutting losers. But at the same time, if you come up here, this is your target one, maybe, you take profit, then as it comes back down, who cares? You're already in a winning trade, right? It could be very difficult for that to turn into a losing trade if you've locked some money on it. If you don't lock the money, then as it starts to come down, you feel a little anxious, maybe a little frustrated, and You're like, why didn't I do that? Why didn't I just do that? It can happen. And many traders have gone through it, and you have to get used to the routine of taking those profits. When you break that discipline, it will really affect you, and it's hard to get it back. So that's why practicing the discipline, okay, you know what, with paper trading, practice getting out of trades. Don't even try to necessarily aim for profits. Just practice getting out. Over the next week, practice getting out if the trade goes against you. All right? Practice pulling the trigger for risk management. And then, you know what? If it sets up as an opportunity to get back in, you're allowed to get back in. But you have to practice cutting the losers. It's an unnatural feeling because most people want to be right. Your ego wants you to be right. Right? Push the E out of the way, get rid of that ego, and just go for it. Right? Just practice taking losses. Practice a small loss. If you see it going against you, Jane said, take my loss now before it turns into a really big one. There's going to be other opportunities. There always are in the market.
What percentage would you say that we should take losses at? Okay, so like, let's say we dealing with like a $50,000 account.
Right.
And I'm gonna ask what percentage, but also like what position size?
Well, here's the thing. It's going to also depend on what you are trading, right? If you're trading a $5 stock and you have a 5,000 position, that's 1,000 shares. You have a $50 stock, you're trading 100 shares, still $5,000 position, right? But if it moves down $1 on you, you're down $50. If that $5 position moves down 50 cents, you're down $500. So you also have to see what you're comfortable trading. If you're only comfortable trading the lower price stocks, remember, don't aim for the profits. Aim for risk management. The profits will come. When you trade with proper risk management, the profits come easily. It doesn't matter. So if you are trading a $50 stock that has a $3 range throughout the day, you have a great entry, you have 100 shares, you get in somewhat near the bottom, you get out somewhat near the top, you've locked in $270. You get in on a stock less than $5 and you have a 1,000 share position and it goes 30 cents against you, guess what? You're down 300 like that. It goes up 30 cents, yeah, it can come back quickly too, but it's higher risk based on the position size, right? Okay, we got a lot to cover. So when we're looking at entries as well, you want to look at the previous support, right? And then, hey, you know what? It came up, it tested it, so we came up, tested it, okay? There seems to be a bit of a resistance right here. And it came back down, it tested it. We see volume coming in down here on the candlesticks, all right? And you know what? This is where you could get in. This is your, we'll call it your $5 mark. Or maybe this is just a round number. Maybe it's $20, okay? This is $20. You know what? Give it 6 cents. Go down to 94.
494?
Yeah. Don't let it go big against you. If it's trading really quickly and your spread is 6 cents already, don't trade it. Try to concentrate on the ones that have that penny spread. And when you see the volume coming in, okay, get in here. You know what? It comes down 494, you get out, cut your loss. Okay, you know what? It comes back up through. You're allowed to get back in, but you need to be extra diligent on getting out, right? Then it comes up, and this time we see, oh, there's some sellers telling the story that they might sell here, but wait, it comes back up, okay? Maybe this, you see this as your resistance area, you take 50% off. right? Maybe this is 520. Remember, you're going for the base hits time and time again. You don't need to have a dollar move. You have 1,000 shares. For example, if you had 1,000 shares right here, it goes down 6 cents, then you're down 60, right? It goes up 20 cents, you're up 200. Or you take off 50%, sorry, you're up 100. You could set a 20-cent trail, right? Then it goes up, it follows it up. Maybe this is 540. Whoops, totally didn't write that very well. Pulls back, hits 21, doesn't hit your 520, and then it continues up. Oh, this is now 545. This goes to 25 cents, right? We'll call each one of these 10 cents. And then, okay, so you get out at 525. But now you've locked $125 here. Right? So your total would be $225. Even if it came all the way back down here, it doesn't matter. You've locked in the $100. Right? Make sense? You can see how psychologically it can keep you in the trade. So that maybe it goes up and it hits $8. You have an amazing trade. You still locked $100 early, so you stayed in the trade. There's no more risk on the table. You've already taken profits. It's eliminated risk. And then you can set a stop and there's no issues there. All right. So we have support and resistance, very important to also use for your risk management. You want to have that support hold, right? So if you get in here and you don't take any profit up here, that's okay, sometimes it happens. You need to get out if you see that it's penetrating that support to the downside, okay? Are you there, Kyle? I think it froze. Oh, no, you're there, okay.
Okay, so most of the time I use the VWAP.
Okay.
On these, the I guess I'll have to actually see it in the VWAP, but at what point is this I guess I'll have to see the three layers or whatever. At what point is this in there though? Is this
This is something that you would start to see. The more that you see charts, you will start to see the support and resistance. And you'll also see how here it's a support, right? It's that base. And then once it's broken, it becomes a ceiling over here. Because people that bought up here, now you have sellers lined up. And another way to conceptually visualize it is you have all the buyers right here, right? The buyers are buying it and taking it up. They come back, they test it. Guess what? No more buyers. The sellers are winning. The sellers are telling the story of the chart by taking out this support. Bye-bye, we're going down. There's no more buyers here. Where is that next level? And I'm going to teach you as well that the Camarillas and pivots can work like this, and you guys are going to love it. And so it'll come down, and sometimes you'll see intraday that it will just play with the support and resistance throughout the day. So this could be a 5-minute chart. This could be a daily chart. It could be a weekly chart. You will see support and resistance on all different time frames. Does that make sense?
Yep.
Okay. Let's continue forward because we got a lot. So you guys asked about level 1 and level 2, right? So level 1, you have your ticker, right? And then it's going to show you the current price at which it is trading. You also have the current bid and ask, so the maximum at which somebody is willing to buy, and the minimum at which someone is willing to pay. So for right now, for this Apple example, what is the spread? So this is the bid. Can you see it right here?
1 cent, huh?
It's 1 cent, right? We also have the day range of where it opened excuse me, it opened up here and it's red on the day. This is going to be the price from the day prior's close, not from the open. All right, so it opened lower than yesterday's trading price. We also have the 52-week range, and it will also show us the volume for the day. Not all of them are going to show you average volume or market cap. Most of them do. Then we have the level 2 data. This is more what you get from your broker. And again, it's going to have your ticker. It's going to have that bid and ask. Now, what is the spread on the bid and ask here?
6 cents.
6 cents, correct. And it's going to go deeper into showing you the highest and best offer. So it's HBBO, highest and best offer. And then that for both the bid and the ask. All right. And you can see here we also have ARCA and NASDAQ and BATS, PHLX, and those are going to be the ECN books. And here is live action. So ECN is meaning level 3. That's going to be the electronic communication network. It's the digital system that matches the buyers and the sellers together. And when you also have level 3, you can ask your broker. You guys are using Thinkorswim, or is it just Mike? Yep. Okay, so Thinkorswim is good. You want to see if you can get the NASDAQ book viewer. I'll show it to you on the next one as well. So it will show you where everybody is located. So right now we're at 1458. Let's erase that. So we're at 1450, excuse me, that's the time. We are right here at 39.43 for the bid. But you see how there's lots of different exchanges, right? You have all of these different exchanges that your order could go through. And then down here you have GSCO. This is Goldman Sachs. So Goldman Sachs is a very big institutional player in the market. And it's important to see where Goldman is buying and where is Goldman selling. And if you watch, and you're watching level 2 throughout the day, you're not always going to find them on penny stocks, $5 or less. But mid caps, small caps, and then the large caps, always. Mid caps and large caps usually, small caps, sometimes. Only if it's really had a big announcement that they're going to be trading on a big move. So Goldman Sachs can somewhat indicate the direction of the stock of where it's going to go. So if you look at it pre-market, you'll see where Goldman is lined up on the books at 9:45 in the morning and right here as well. Now, maybe the price action starts to go up and you see Goldman move at 42.50, right? Well, you want to notate they were selling at 42.27. It goes to 42.27, maybe you take a little bit of profit. If it stalls there and that creates that resistance, there might be a big institutional seller that is selling right there at that price. So it's good to know where where is the biggest seller, right? Right here we have the biggest seller. Oops, now the biggest seller is at 34.95 right here for the NASDAQ book, right? 5,800. And you can see a change. And there's also something that when you start to see that maybe there's orders that keep popping up right here. This keeps increasing in size and it's just stalling right here. Like it's going to 6, 7, 8, 900,000 right there. Maybe there's a really big order and they're hiding it, right? Maybe they're hiding that order. And so they could have 1 million shares that they're trying to sell, but they're only putting up 100 shares at a time. That's called refreshing. I'll try to grab a clip too for you guys to really show you really well. So the really big ones for ECN books are ARCA, which is Archipelago. Then we have NASDAQ, the NASDAQ book viewer, the Instinet, this is actually with an I, and NASDAQ book viewer. I don't know why I put it separate like that. So the NASDAQ book viewer, if you guys want to have access, you should have access through Thinkorswim though, but if you are trading, say off of Robinhood, and you want to have that information and Robinhood doesn't provide it, you can get it through the NASDAQ book viewer. It's $15 a month. And also on Thinkorswim, you can get it as well. And it will show you where everybody is lined up. GSCO, you can see GSCO is lined up here twice. And on the selling, not lined up for selling at all. We have NASDAQ up here. And we have JP Morgan right here. So this is where the big institutional traders are trading, which is really important to watch if you're in a large cap stock, because they can be the ones that can halt that stock from moving further, or they're buying and they continue to push it up.
So, okay, so you're talking about like Goldman Sachs, JP Morgan. Does it tell you what they're buying?
Does it? Well, for this example, this stock is IDSA, just as an example. So you'll see them on Apple, you'll see them on Twitter, you'll see them on Uber, Tesla, you know, the larger cap stocks, most of them would be over $5 though, because they're not allowed to trade $5 and less. $5 and less tend to be manipulated by the big day traders that have a lot of money as well, but they're not showing their hands quite in the same way, because you don't see, all right, well, we have maybe Tim Gertani selling right here. You can't see that. And if they're hiding their order, you won't see it either. They might set up a large order. For example, the largest order buying right now is right here, 1410. And the largest order selling is up here at 1425. So you want to pay attention as well if you're getting into something as a long. Where is that highest large order to sell? What is your potential profit? Not just on the chart, but also on the level 2 book. All right? Because if they're setting up, now say you wanted to get in, you think you're getting in, you're like, yes, I got a good order, 1411, I am in on this trade. Well, guess what? At 1414, you have a 10,000 share person to sell. Do you think that was such a good trade to get in? You only have 3 cents. So it's another layer, right? It's another layer that you have to look at. It's not just the chart. You want to see where they're lined up, because if it's setting up, maybe it's gapped up on that day, and again, maybe they had a big seller right here. Maybe this is 10,000 instead of 100, right? Well, then maybe they just popped it up for that day to sell and take it down. Does that make sense?
So for entering a trade, right?
Yeah.
I see that you said, okay, so if someone was buying at let's say 1411, but yeah, you see that at 1415 you got your 200, you got your 200 sales, and you got another 100 sell at 1415. Mm-hmm. What would we need to see on the sell side to be like, okay, we got the green light?
Well, you know now, yes, there's 200, 200, 100. There's more buying power right now because you have more buyers lined up on the level 2 than you do sellers. You want to pay attention to the really big orders. Like this is up here at 1425. Okay, you have 14 cents, right? If you're buying 1,000 shares at 14 cents, you've made $140, right? But you also want to be conscientious that maybe you want to get out at 1424. You don't necessarily want it to go all the way to 25.
Right.
Make sense?
Yeah, probably 1422, 1420.
Yeah, exactly. Well, I would go 1424, just a penny.
Okay.
And then if you see that it stalls at 14.24, and hopefully your trade gets executed. If it doesn't, drop it, get out. If you feel the tension in the price action, you can get out. Or maybe they're loading up as that's the point at which they wanted to buy. And sometimes you'll have a really big order and it'll be just to stall the price for them to load up to take it higher. There's a lot of manipulation. So you got to really watch the price action. And you always have to remember that there's always a buyer and there's always a seller, or this way, buyer and seller of every transaction. So you have to think of who are you dealing with on the other side. If the price stops and it's created that selling price action, there's a big whale on the other end of that, probably. And they are probably going to take it down. Vice versa. If it stops and it creates a support, you've got that whale buying up all those shares. Maybe it's Warren Buffett and he's buying all these shares right here and it's going to skyrocket in 2 days when the news comes out that he just bought it.
Whenever you do the whenever you view the dark pool,
yep,
can you tell what stocks they're buying?
I'm going to show you that. Okay, so we have the time and sales, right? And time and sales will, again, we have NASDAQ here. So this is the bid and ask. This is Apple today. And we have where it's going through on the ECN book. Right here, this ADF, ADF or NADF is the dark pool exchange. That simply means that somebody has chosen to hide their order. You and I can do it. Certain brokers will give you the ability to show 1 share, 2 shares, 5 shares, 100 shares, and that if you're hiding your order, it's going through a dark pool exchange. Sometimes it could be a really big order of a really big whale where it's millions of shares, or it could simply be somebody selling 1,000 shares, but they don't want to show all of the 1,000 shares on the bid and the ask. You have a question?
Whenever I see it, it's always one. Like they always buying one. Like nobody's gonna buy one.
Exactly.
Share or something like that. But I got you.
Exactly. So they're hiding it. They're hiding their order, right? Okay. So here's another example of how they play their tricks, right? This is why resistance and support, I lost my drawing. So why resistance and support are so important. It comes up, oh, it tests it, psych, nope. Take it down, and then nope, they're not done buying yet. They still take it down. All right, we're done buying. We're ready to take it through. Boom, it shoots up. And so that's why waiting for this to break will be that higher probability trade, right? You could get down here. You could get in down here, but remember you want to leave that stop tight because you need to have the confirmation. And you'll also see, okay, well, maybe we have volume descending, ascending, descending, and then finally, boom, volume goes up, right? Right as it breaks out. Because you also have the shorts that also put their stop just above right here. And then as it breaks above, the longs get in, the shorts get squeezed, price action goes up, and it rallies on that next move. So this could be a 5-minute chart, or this could be a daily chart. You've seen it on my midday streams where with AMD, this is that range of consolidation where it might trade there for 3 weeks, 3 months. And then once they're finally done, guess what? Up we go. All right. So
if it's bouncing off resistance like that, is there anything, any one thing that you look for before it breaks out?
Volume. You want to look at the volume down below. You want to see that the volume is increasing. All right. If you are here and you're constantly seeing that the volume's dropping off right here as it comes to it, then this third time, it's not always going to be the first time. Usually the first time, it doesn't always break through. You want to see it test and then break it, right? Because that means that there's still sellers there. They're not done selling it for whoever's selling it. And then as it comes here, you want to see the volume going up with it. If it's starting to drop as it goes up, that's typically an indication that it will reverse instead of continue. All right, so you're asking about the blocks, right? Well, you guys can get it. It's called Data Trader Pro, is one of the resources, and this will show it to you in real time. And there's also a couple other ones like Flow Trade. You've seen me show Flow Trade as well during my live streams. That also has block trade information. You can search certain blocks. They have this information that will pop up for you as well. And there's also this one, like this. This is also Live Vol Pro. And like today, look at this. Oh, I can't draw on here. I'm so used to drawing. You see this? 1 million, 1 million, 8.44, 844,000, 735,000, right? We had roughly 3.5 million shares.
Is this today?
Yes, this is today.
Okay.
So now you guys can track this, right? This will be your something to track over the next week, right? Look at the chart. So we have, it's going to load the chart here really quickly. This is a daily chart. Let's do, yeah, we'll do daily chart. Okay, so right now, it pulled back. We're at 2164 right now. No. Hold on. 930. Why is it only showing 930? Okay, here we go. So you can see, hey, look at how they held it right there, right? They were holding it all day, right? They were holding it, holding it, holding it, holding it, holding it. So you know what? If they can break it above, we had a bit of it holding over here too, and where did it go? Once it broke that resistance, boom, up it went, right? This might be something that has to do with stimulus, and that if they print a lot of money, the US dollar will likely go down in value and metals tend to go up. But we don't know what's going to happen. We know we have 3.5 million roughly between 2243 and 2253. So if we see that all of a sudden this goes and it goes up above 2280, there's a good chance that was buying. If it goes down and it breaks below over here, 2172, they were selling. So the dark pools can really maneuver, and seeing this, it gives you an edge, because then all of a sudden, hey, we also know, let's go back, see if I can do 1 month.
Oh, it doesn't tell you if they're buying or selling?
No,
Okay.
it doesn't tell us, but we know this is a time and sale. This is a print, right? So we know that it's a completed trade, and we will be able to tell from the price action later. Now back here, it was back here this day. We had 5 million print. The 21st, I think. Let's see. I think it was the 21st. It's loading the prints. And when we see, okay, right now, we had 1.125 million that day. Trying to remember what day it was. You know what? Here, we just look at my chart. I can do it right here. We'll go to silver. It's on my chart, the 2 days that we had massive prints. And you can see I was watching silver today because of those prints. That's going to take a second to load. And so you guys can now track this. You guys can become believers and followers. It was back here, September 23rd. We had a 5 million share print. And then we had another 1 million share print. There we go. 5 million shares at 21.49. Hey, Google, what's 5.06 million times 21.41 cents?
Sorry, I didn't understand.
Didn't understand.
Hey.
No. Hey, Google, what's 5 million times $21.41?
The answer is 107.05 million United States dollars.
$107 million position. Do you want to follow that or do you want to go against that?
I want to follow that.
Right? And we had, hey, Google, what's 3.5 million times 2250?
The answer is 7,875 million.
It said 7 billion, but I don't think so. Maybe 7 million. That would make more sense. No. Hey, Google, what's 2250 times 3.25 million?
The answer is 7,312,500,000.
Yeah, 7 million. So, do you guys want to fight that or you want to go with it? Yeah. So that's why we wait. Got it set up here. Here's that print. That's the green. We had a print here. We had a print here. And now we have another print here. So are they going to take this up? If we go back here, we look on the weekly chart. And what happened back in 2008? Right? 2008, it dropped down to $8.45. And then it skyrocketed 600% to $48. So you can see we're at another point. We had a double bottom on the chart, which we'll talk about chart patterns too. And then now we've broken out among the moving averages. On the weekly chart, it's slowly looking like maybe it wants to curl down from here. And on the daily chart, we slowly have a signal of it breaking out. So more to come. All right. You look like you're excited for this trade. Licking your lips like you're ready to place a trade once it moves, Kyle.
Yeah, definitely.
Yeah, that's it. So we'll watch it, right? If it breaks, my point at which I would say yes would be right up about here. I want to see it break above this 21 EMA, so 2280 area. If it can go up and break above there, then likely that trend is continuing up. But there's no guarantees in trading. Even if you know this information, if they wanted to sell more, what would they likely do? They would likely take it up and sell more. However, what did they do? Well, it slowly went up. They bought more here. They pulled it back. I say buy because we're above it. Right? They bought more. They took it up. Oh, no, wait. They're not done yet, maybe. Maybe they're buying. They brought it back down potentially to buy because they didn't have enough, right? 5 million shares wasn't enough. They had to add that 3.25 million on. Right? So slowly but surely, is it coming together a little bit more for you guys?
Yeah, definitely.
Yeah? Okay, cool. And I'm going to get the recordings up too for you all, so you'll be able to see them online and reference them as well.
Where would they be at? On your website or?
Yeah, I'm going to shoot you guys the links. It'll be a private page where you'll be able to view them.
Right.
And it'll be on demand, so you guys can watch it right there. All right, so thank you guys. We went over a little bit today, but lots of good content to cover. And more stuff on Friday, all about paper trading, journaling, and really keeping track of it. All right?
All right, thank you.
Thank you.
My pleasure. And if you guys have questions as well on that subject matter, something else you want me to fit in, shoot me an email or shoot me a Twitter message as well.
All right, you have a,
All right. Thanks, guys. Have a great afternoon. Bye.
all right, later.